All right, here we are with my buddy Alex, and we're going to be going through some things, some of the questions he's got, and answer them one at a time. So, and then I've got some earnings trades I was going to show you that I put on today, kind of see how they're doing.
Okay, perfect.
So, what questions did you have, my man?
Yeah, so three questions. First one I think is rather easy, and I might have figured it out, but the other two I had not yet.
Okay.
Um,
You want me to share trade diff? I think the first question might be about that.
yeah, sure. Yeah.
Okay. All right. Here is the spreads selling.
Okay, I'll drop to fourth.
All right. And what is it you want to look at?
If you want to go to mine.
Okay.
Number 4.
All right. Okay.
Okay, so in that price column on the left, so that is the current stock price, correct?
Right here?
Yes.
Yes, it is. So if you open it up,
yeah,
that's what AMD is currently trading at.
Okay. I just wanted to make sure that was, and then the strike price shows when that drops down. Okay. Okay, I just want to double check that, and that's just, okay. So, one thing I had a question about, unrelated to that, is the other day, I think we did a vertical spread. I think it was a poor man's covered call, I believe, on one.
Okay.
And we did, what was it? Hold on.
Is that the Microsoft one?
Which one was it? Hold on, let me bring it up.
Because I've got it here. If you're looking at are you looking at my screen?
I remember something was at 180 and 190.
All right. Well, we did a poor man's covered call on Microsoft, where we bought it at 217.50.
Oh, I just did that about an hour ago.
Yeah. Oh, you did it? Okay.
Yeah, that was a new one.
Okay.
We did one here. I got it here. I was looking at one.
Did we put it in your account?
Yes.
Okay.
Can you look through the past ones or?
Oh, you closed it?
Yeah, it was one from, okay, yeah, it was so.
All right, you had, you closed a Visa. That looks like a strangle. You had an AMD.
We bought at 180 and sold at 190. What was it?
Was it a? Okay, I'm looking at your realized, the ones that you closed.
Oh, maybe it didn't close. But it basically what it came down to, I think we were doing an in the money option. So try to buy an in the money option in September and selling an out of the money option in August.
Okay, do you remember what underlying it was?
It was,
because I can put one in on
maybe it was a PayPal strangle, maybe.
Well, if it was a PayPal strangle, it wasn't a poor man's covered call. So I thought you initially said it was a poor man's covered call.
Yeah, that's what I was thinking it was.
Well, let me go ahead and finish your question, but so far you've mentioned poor man's covered call. You're not quite sure of the underlying, and you're not sure the kind of trade it's in. So
I think it was. I think it was in. Okay. So I was going back through some of the our back and forth where we bought a 180 call in September and then sell a 190 call in August.
Do you remember what the underlying was?
Maybe PayPal.
Okay.
I don't know if we.
All right. The PayPal's trading at 197.33, so it sounds kind of like it. So let me put on like a PayPal. We bought, you said the September?
Buy the 180 call in September and sell the 190 in August, which maybe maybe I didn't fully put it in, but I know we were chatting about it.
Yeah. Well, if I was to put this one on today, I might still buy the 180, but I would sell in August since it's gone up. And are you still bullish on PayPal?
So my question is why do we have one that ends in September and one that ends in August as opposed to doing two that end at the same time?
Okay. The reason is I like to buy the long option in the money further out in time. And it gives you a chance to sell premium against it twice. So for example, if we bought the 180 in September and we sold the August 200, then when August 21st comes around, we could roll it to September and get another premium out of it. So essentially what it's like subleasing an apartment for 2 months, and you get to rent it out for both August and September.
Okay, but you only get the first initial premium?
No, you get both premiums. So if we sell it in September at 200, and let's say theoretically it doesn't go to 200, and we get to keep the entire premium. The premium we sold in August was about $4.40. So if we just did one contract, that's $440. Now, and then September, let's say it's unchanged, and we sell another one at 200 in September. We could collect another $440. So one of my favorite poor man covered calls is to buy it as far out as January, and that way I could sell premium in September, October, November, December, and then in January.
So when you say sell premium, is that?
When I say sell premium, it's every time you're selling a short position.
Are those additional short positions, or is that just one contract?
Those are additional short positions. So, right, let me show you here. If I'm long-term bullish in PayPal, and I'm buying the 180, and then I'm selling it in September for 200. And let's do it for 5 contracts. Then I'll hit the analyze this trade. All right, the maximum win on this guy is 180 and 200. Is like $200. No, it's 3,345 just in that 1 month. But see, I can sell premium. When I say sell premium, this is the short call that I'm selling in September is kind of like rent money. So I'm renting out this PayPal crack house here. We're buying this crack house for $10,000. And we're renting it out for, hopefully we'll get $3,500 in rent a month for September, October, November, December, and January. Theoretically, if we do that, we're collecting 15 grand on something that just cost us 10. And that doesn't even require the underlying long call to appreciate. So theoretically, in 4 months, you could be free rolling. And so anything you make on the long call is just, it's all upside.
Okay, so that you'd have to go in and do another contract for October, another one for November, another one for December.
So when it gets to September 17th, what we can do is roll it, hopefully for a credit. Now you may say, well, what do you mean by roll it? Let me show you an example of rolling it. So here's Apple. You know, I've got a long call at 300, a short call at 370. Let's say I create a rolling order, roll that guy, change the date to the monthlies in September, and I collect another $2.62 of rent money multiplied by 3.
Is that what it initially was? The price?
The price, the 370, it was. If
so
I want,
it's the same when you roll it?
It is automatically, it's the same. You know, if I'm still bullish on Apple, you know, I might roll it up to 375. So essentially what I'm doing is I'm paying $2.05 in this case for $5 extra in intrinsic value. So I don't know if you've got to the educational series about intrinsic value versus extrinsic value.
A little bit. So that's the difference between the current price and the strike price of what that kind of that immediate value would be.
Well, you've got two things that are part of an option price. One of them is the time value.
Sure.
And the second one is how much intrinsic value there is. So on the 375, you know, it's pretty deep in the money already. So that option at 375, 438.66 minus 375. So in that option price, there's already $63.66 of intrinsic value.
Okay.
Now let me look at that strike of 375. So the 375 call in September is roughly around $66. So $63.60 are intrinsic value, and it has maybe $3 or $2 in time decay.
Okay.
Extrinsic value.
Kind of brings me to my last question was looking at the calls and the puts here and the bid and the ask prices.
Are you thinking about trade diff or toss or just in general?
We can do this one since we're here.
On trade diff or on thinkorswim?
Thinkorswim's fine.
Okay.
So if you'd scroll to where the price is actually sitting right now, like around the 430s.
438 is what Apple's currently trading.
Yeah, right here. That's where it has these kind of four sectors. So for some reason, whatever I'm thinking about it, it seems to be flipped because, so for example, let's say I wanted to go, I wanted to buy a call.
Okay.
So let's say, so that means I'm bullish on it, and I think it's going to go up, right?
Yes, and you also, if you're smart about buying calls, you think that it's going to go up even greater than your time value.
Okay. So I would pick a strike price that is higher than it currently is, right?
Well, that would be out of the money. If you're asking me for what would a good strategy be for buying calls if I was bullish, see, that's maybe a different question.
Kind of, I mean, sure.
So the one that has the least theta decay is to buy something that's deep in the money. The further you go deeper in the money, the more it trades like stock without a lot of time decay. And see, so here's an example. If you add 335 with 103 or 104, 335 plus 104 is 439, and Apple's trading at 438.66. So that's very little, but you're paying a lot more for it.
Yeah.
So the deeper you go in the money, the less you're paying in terms of VIG or theta that's going to hit you in the face.
So that's what I'm not understanding about. So for some reason I have it flipped. I feel like if I think, Apple's going to go up to, let's say, 445 in the next 2 weeks.
Here's a simple example. See how cheap these options are if you're buying an option at 580?
And that's why I don't understand why I feel like these would be the ones that would be more expensive.
No, because it has to go up to 580 before you start making anything. So this is a lottery ticket. You're buying a lottery ticket, basically saying by September 18th that Apple's going to go up to 581. It's currently trading at 438.
Sure, and I'm just talking about ones that are like closer, like let's say 445. Let's go to that.
I just thought I'd give you like a ridiculous example to kind of see, how much a person would be flat out gambling.
Yeah, but that's what I'm saying. The ones closer, like right around here, like let's say the 445. Why is that cheaper than per se like where it's at 430?
Because 430 is close, is in the money. So some of this is intrinsic value.
I'm saying if you think it's going to go up, why can you buy a contract that's already in the money? Like that doesn't make sense to me.
Well, because you're paying for it. The deeper in the money, the more you have to pay for it. And the less time value it is. So let's do an example here. I think maybe an example. So let's just say you buy the 400 and it goes to 450 by September 18th.
So it's
now
above the strike price and it goes even higher above it.
Yeah, and so you turn around, that gives you the right to buy it at 400 and sell it at 450. But you paid 45 for it.
Okay.
So you buy it for 400, you sell it for 450. So your profit is $50, but you paid $45 for it, for that option.
So buying it underneath the strike price is like almost like a little bit of a built-in safety net, so it can still drop a little bit.
No, buying it further out of the money is more of a gamble because. Say your question again.
Sorry. So I get that buying it above the strike price, let's say at 440 and up, is you're gambling that it's still going to go higher.
Mm-hmm.
If you buy it at 400, it's already in the money. So even if it drops to, let's say if it drops from 438 to 430, I mean, you're still buying it at 400, correct?
Yeah.
So you're still in the money.
Where the gamble is, the further you go in the money, the lower the probability that that long call that you bought expires worthless. That's your biggest risk. Because if by September 18th, if you bought the 400 and it's trading at 399, you lose the entire value of this 400. Because nobody's going to buy something for 400 and then sell it for 399. You'd be losing $1.
Sure.
So the only way it has value is if it trades above that at the strike price. So therefore, the deeper in the money, the lower the probability. So you see it at 400, there's a 25% probability that it trades below 400 by September 18th. So see these percentages, see how they get smaller and smaller, the deeper you go in the money, till you get to 365 and there's only a 10% probability. So one way of looking at it is there's a 25% chance that you lose the entire value of that long call that you've bought. Now, granted, 25% is low, but sometimes it still happens.
Okay.
Now, if you don't if you're buying the January, and collecting all that premium along the way, theoretically by the fourth month, you might have be free rolling. So even if you lose that entire value of that long call, you've collected enough rent money to basically negate that risk.
Okay, I think I understand a little more. So that's what was throwing me off. I didn't realize that you could buy a strike price that was lower than the current price.
Yeah, that's called buying an in-the-money option. And the reason it's called a poor man's covered call, you're buying that long call is kind of your replacement for stock.
Okay, so now that I understand that, would you mind explaining that first one again?
The PayPal?
Why you buy, what was it, on the shorter time span? Or what was it?
Why I go deeper in the money. The deeper you go in the money, the more it acts like stock, and there's less time decay. There's more intrinsic value, and there's less time decay.
Okay. So that's why you buy farther out and sell closer.
Oh, that's your question. Why you buy further out and you sell closer. The reason I like to do that is that you could sell premium multiple times.
Okay.
See, if I'm buying the October and selling the August, I could sell the short side in August, and then I could sell it again in September, and I could sell it again in October. So I got 3 months. If I'm buying the January and I'm selling the August, September, October, November, December, get several months. It's almost like subleasing a place and then renting it out for 5 months.
Okay, so what would be the negative of doing it where they have the same expiration time?
You just get to sell. You almost have to view it as one trade.
Okay.
You just take off both legs, closing both legs at the same time. And I might do it in the same month if I had a bullish or bearish premise that's short term.
Okay.
But if I'm long-term bullish on something, I like to buy longer term out, further out in time, and then sell the front month.
Okay. Okay, this makes more sense. Yeah, I just didn't realize, because I saw why the bid and the ask were so expensive, but it didn't make sense because I didn't realize that you could buy a strike price that was lower. I didn't realize that was
in the money.
Yeah.
Yep. And the reason people do that is because there's less time decay. Let me see if here's an example. I'm playing also in the contest of calls and put buying, right?
Mm-hmm.
This is primarily more people that gamble it up. And what I want to look at is I want you to look at how much Mo's daily theta decay is minus 5,436. So he's got to fade that rake before he makes money every day.
Okay.
Look how much mine is, minus $75. And the reason is everything that I've bought is deep in the money and it's long-term bullish. See, I've got a lot of holdings here. But see, I bought Apple at a strike price of $350, Intel at and I'd have to show you these strike prices, but each one of them are deep in the money. So they trade more like stock and they have less time decay. Now, Mo is buying like way out of the money, 3-cent options, these, 500 contracts.
Okay.
It's just extremely risky things, but right now it's working for him. I'm just hoping to be kind of like he's the rabbit, I'm the hare, I'm the turtle. I'll just kind of keep plodding along. I'm hoping that I'm fading minus $74 a day, and he's fading minus 5,536 a day. So what
Okay.
I'm hoping is, the one time it goes against him, it's like not only does it go against him, but it goes against him to plus 5,500 by not being right.
Okay.
So that's a little bit. So a little bit about theta decay, which is it's one of my favorite things to watch is daily theta. So if you look at our spreads contest, and granted I'm not doing great, but I do have $1,267 a day in positive theta decay. So I'm forcing the market to beat me because I'm collecting $1,267 a day in essentially rent money, and I'm forcing the price of real estate to beat me.
Okay. Okay. Well, those were my main three questions today. And I said I'm still going
Okay,
through those videos, but thankfully it's starting to make sense now.
cool. And I would say, do you want to put some trades on today? But it's after market hours, so we really can't put on. You want to just chat about anything that you're bullish or bearish on?
I would say I'm bullish on Microsoft right now.
Okay. Do you currently have anything in?
I did that at the end of the day today. I got one in.
Okay. And what trade did you make?
What did I do? Let's bring it up here.
Microsoft is at 213.29, so selling a naked put would work.
I did a poor man's covered
Call.
Or call, I believe.
Yep. Okay. Nice. Well, let me show you the three trades I made today. Was in Planet. What's the Planet? The Fitness, Planet Fitness, Disney, Boeing, and Beyond Meat. And Disney, Beyond Meat, and Planet Fitness were all earnings trades.
Okay.
And Planet Fitness, I just needed it to stay above 55. It's currently trading at 51.95, so that one looks like it worked. Beyond Meat, I needed it between 113 and 180. It's currently trading at 133.50. And the last one was Disney. And Disney looks like it's doing well, 123.65. And I just needed it between 108 and 127. So all three of those look like it's like at 3 for 3 today. Did you put on any of these today?
No,
Okay.
just one Microsoft.
All righty.
So, as I've been going through the, what type of trades were these again? You said
These are strangles around earnings. So one of my favorite in the day before earnings, volatility is very high, which basically means you get paid for taking a risk.
Okay.
It's like the hurricane's coming and you're selling hurricane insurance. And so what I like to do is sell strangles.
And so, as I'm getting an idea of some of the stuff I learned today, so I heard you say you want the price to stay between those two.
Yes.
So is that different from like a spread where either you want it to stay higher than or lower than the two that you've put?
It could be similar to a spread. How this is different is it's an undefined risk trade where you're selling both a put and a call out of the money in the same expiration.
Okay.
So here's Disney. That's what this trade looks like. It expires on Friday. During market hours, it looked like it had like I don't know, 90% probability of profit. It's showing, I guess, this based upon the after hours movement. But as long as it stays between the price of 107 and 127 by Friday, then I make the full premium of 528 bucks. It's currently trading at 123.51.
Okay, so a strangle is selling a call.
Selling a put and a call.
Okay.
In out of the money in the same expiration. Now, you might ask, how do you pick your strikes? So let me show you under Disney. Now, these prices would have been more representative if it was during market hours, because these aren't going to be real accurate now, since there's, so for example, see over here where it says Delta. I like to sell the 10 Delta. So it's like 0.11, the 10 Delta strangles. So I would pick, now these prices are way off. They're not even representative of what's real because options aren't currently trading. But I'd click on that one, holding down the control button, and then I go to this 10 Delta and click on that one. So I'm selling both a put and a call in the same expiration. Okay. And I'm collecting a premium. So you're basically making a wager that it's going to stay between two particular prices by expiration.
So you're just staying really on the outsides of the bell curve that everything lands in the middle of normally.
Yep, it's called a neutral trade.
Okay.
So you got bearish trades, you got bullish trades, you got neutral trades.
So you just want to stay in both in the zone.
And it's best to do neutral trades on things that have high volatility. Volatility is the perception of fear.
So that do have high volatility?
Yeah, because you get paid more for taking risks.
Okay. And that would be around an earnings call?
Around an earnings call is one of those more risky times.
Okay.
But the 10 Delta is real far out. It's a wide range. Most of the time, its probabilities are 80+%.
Okay.
My sweet spot is greater than 75%.
Okay. Okay, starting to make more sense.
Cool. All right, buddy. Well, anything else?
That's it for today.
That's it for today. Okay.
Going through more of these videos, and each day gets something new is finally clicked, so it's good.
Nice. Well, if you want, post on Collaborate into our contest so everybody can see it. And I continue to post stuff there, and I'll post this video there also.
Okay, perfect.
Okay. All right. Good to see you, buddy.